Ever wonder, who keeps the tax system running smoothly? On the professional side, I mean. Or what rules govern the folks you trust with your most sensitive financial info? Well, today we're doing a deep dive into a really crucial document, Treasury Department Circular 230. Now, it might sound a bit dry, but trust me, it's absolutely essential. It sets the ethical to professional standards for tax practitioners, everyone from CPAs to your local preparer. So, our mission today, let's unpack this thing. Turn what looks like dense legal text into clear insights about what you should expect, really, about their responsibilities. You're going to walk away understanding who can practice before the IRS and the strict duties they have to uphold.
That's right. And it's fascinating because Circular 230 isn't just some dusty rule book. It's really the bedrock of trust between taxpayers like you and their representatives dealing with the IRS. And it brings up some really important questions about accountability, in a practical way.
Okay, let's unpack this then. So,
Yeah.
at its core, what exactly is Circular 230?
Simply put, it's an IRS publication. The official title is Regulations Governing Practice Before the Internal Revenue Service. Think of it like the ultimate professional playbook for anyone representing taxpayers in front of the IRS. It covers, well, everything from who's even allowed to do that to the specific rules they must follow, their conduct, and what happens if they break those rules.
So it's not just a suggestion, it's a whole framework. How's it structured? Is it easy to follow?
It's pretty logically organized, actually. To connect it to the bigger picture, there are 5 main subparts. You've got Subpart A, which is all about who has the authority to practice. Then Subpart B gets into the real detail, duties and restrictions. That's a big one. Subpart C covers sanctions, what happens when things go wrong. Subpart D explains the disciplinary proceedings, the process. And finally, Subpart E has some general provisions. Each part kind of builds on the last, creates a comprehensive framework.
That structure makes sense. Okay, let's dive into that first one, Subpart A. Who actually gets the green light to represent you or your business before the IRS? It's not just anyone, right?
Absolutely not. The IRS wants to ensure, a certain level of competence and ethical standing. So the main categories are attorneys, certified public accountants, CPAs, we all know them, and enrolled agents. EAs specialize specifically in tax. Beyond those, you also have enrolled actuaries and enrolled retirement plan agents for more niche areas. And there used to be registered tax return preparers, though their scope was always more limited. The program's status has changed over time, but the idea is specific groups are recognized.
Okay, so quite a diverse group of professionals there.
Yes, and that diversity is actually key. It means the rules in Circular 230, they need to be broad enough to apply to all these different backgrounds, but also specific enough so that everyone is held to the same high standard of conduct. You should get professional representation regardless of the exact title.
Right. Now, Subpart B, the duties and restrictions. This feels like where it gets really interesting for taxpayers or anyone curious about ethics in the field. Let's break down some key duties. How about starting with transparency? What info do practitioners have to give the IRS?
This is fundamental. Section 10.20 covers this. If the IRS asks for information or records, and it's relevant to a client's tax matter, the practitioner generally must hand it over. Now, there's a key exception: privilege. If they believe, in good faith and reasonably, that the info is privileged, think attorney-client privilege, they can withhold it. But here's a crucial detail. If they don't have the info, but they know who does, they have to tell the IRS. No stonewalling allowed. It ensures the IRS gets what it needs to, do its job.
Okay, it's clear. What about finding a mistake? What if a practitioner discovers their client made an error or left something out on a past return? That sounds awkward.
It definitely can be an awkward conversation. But Section 10.21 is unambiguous here. The practitioner must promptly advise the client about the noncompliance, the error, or the omission. And just telling them isn't enough. They also have to explain the potential consequences under the tax law. It's not optional. It's about getting it corrected and making sure the client is fully informed.
Full disclosure, even if it's tough news. Okay. And how careful do they need to be? Diligence. Are they just taking your word for everything when they prepare your return?
No, absolutely not. Section 10.22 hammers this home. Diligence as to accuracy. Practitioners have a duty to exercise due diligence. That means being careful and thorough when preparing or filing documents and when making any statements, oral or written, to the IRS or the client. They can't just blindly accept everything. Now, they can generally rely on information from the client in good faith.
Well, there's a catch.
There's a catch. They cannot ignore the implications of information they already have or information that seems questionable, incomplete, or contradictory. If something looks fishy or doesn't add up, they have to make reasonable inquiries. Think of it as a professional skepticism requirement, a
Well,
quality control check.
that's a really important point.
Yeah.
They need to use their professional judgment. Okay, what about speed? Can they just let your case gather dust?
Nope. Section 10.23 is pretty clear. Prompt disposition of pending matters. Practitioners are explicitly forbidden from causing unreasonable delays in any matter that's before the IRS. Things need to move along.
Makes sense. Now, who they associate with? Can a practitioner get help from, say, someone who's been kicked out of practice? Or maybe a former IRS employee?
Ah, good question. Section 10.24 deals with this. It's about maintaining integrity. They cannot knowingly accept assistance from or give assistance to anyone who is currently disbarred or suspended from practice before the IRS. And dealing with former government employees, especially from the IRS, has even more specific rules under Section 10.25. It's all about preventing conflicts of interest.
Conflicts of interest. Tell us more about those rules for former government folks. Sounds like it could get complicated.
It can be, but the rules are there for a reason: fairness, preventing undue influence. So, for example, if a former government employee personally and substantially participated in a specific tax matter, say, audited your company while they were with the government, they can never represent or assist any party involved in that same matter after they leave government service. It's a lifetime ban for that specific matter.
Wow, a lifetime ban.
For that specific matter they worked on directly, yes. Now, if they had official responsibility for a matter, maybe they supervised the person who did the audit but didn't do it themselves, and there's a 2-year cooling off period. During those 2 years, they can't represent parties in that matter. They can, interestingly, provide some assistance behind the scenes to their new firm, unlike the first scenario. And there's another one: influencing rules. If they helped develop tax rules or had official responsibility for them in their last year, they generally can't appear before the IRS for 1 year after leaving to try and influence those specific rules. It prevents leveraging inside knowledge unfairly. Firms hiring these individuals also have a duty to isolate them from conflicting cases. It's pretty comprehensive.
Definitely sounds like it. Okay, shifting gears a bit. A practical question. Can my tax preparer also notarize my tax documents? Seems convenient.
Convenient maybe, but Section 10.26 says no. A practitioner cannot act as a notary public for their own clients regarding any matter related to IRS practice. It's a clear separation to avoid potential conflicts and maintain the independence of the notary function.
Good to know. Let's talk money. Fees. Section 10.27. What's an unconscionable fee? And what about contingent fees getting paid based on the outcome?
Right. First, practitioners absolutely cannot charge an unconscionable fee. Now, unconscionable isn't rigidly defined, but think grossly excessive. A fee totally out of line with the complexity of the work, the time spent, the skill required, and what's typical in the field. It's meant to prevent price gouging. As for contingent fees, where the fee depends on achieving a specific result, like a certain refund amount, those are heavily restricted.
Heavily restricted, not banned entirely.
Not entirely banned, but almost. They are only allowed in 3 very specific, narrow circumstances. 1, if the fee relates to an IRS examination or challenge, like an audit of an original tax return or an amended return filed soon after notice. 2, if the fee is for a claim solely seeking a refund of interest and or penalties, not the underlying tax. And 3, if the fee is connected to a judicial proceeding under the Internal Revenue Code. Outside of those 3. Contingent fees are generally prohibited for preparing returns or giving tax advice. The IRS wants advice based on the law, not driven by the practitioner's stake in the outcome.
That makes a ton of sense. Keeps the advice impartial. Okay, another practical issue. Getting your documents back. Section 10.28. What if you need your records from your preparer?
This is a big one for taxpayers. Circular 230 is very clear. Practitioners must, upon request, promptly return all client records, and client records is defined broadly. It includes stuff the client provided and things the practitioner prepared, like returns or work papers that are necessary for the client to meet their tax obligations. They can keep copies for their own files, of course.
What if there's a fee dispute? Can they hold your records hostage?
Ah, the fee dispute issue. If state law specifically allows a practitioner to retain records in a fee dispute, Circular 230 permits it to that extent. However, even if they retain some records due to a fee dispute under state law, they must still provide the client reasonable access to review and copy any records the client needs to comply with their federal tax obligations. They can't completely block you.
That's a critical protection. Okay, conflicts of interest again. Section 10.29. Can one practitioner represent, say, two business partners who are starting to disagree on tax matters?
Generally, no. If representing one client will be directly adverse to another, or if there's a significant risk, the representation will be materially limited by the practitioner's responsibilities to someone else or their own interests. But there's an exception with strict conditions.
What are the conditions?
First, the practitioner has to reasonably believe they can provide competent and diligent representation to each affected client. It can't just be wishful thinking. Second, the representation isn't prohibited by law. And third, each affected client needs to waive the conflict of interest based on informed consent, confirmed in writing by the client, usually within 30 days of giving consent. It's a high bar, requires full transparency and explicit agreement from everyone involved.
Informed consent confirmed in writing. Very important. How about getting new clients? Advertising, solicitation, section 10.3. What are the rules there?
They're pretty strict about truthfulness and avoiding pressure tactics. Practitioners cannot use any public communication or private solicitation that contains false, fraudulent, coercive, misleading, or deceptive statements or claims.
Can you give us an example of something that would cross the line?
Sure. Let's say a tax preparation firm runs an ad saying, "We employ top former IRS auditors," when in fact they don't. Or maybe they have one very junior person who briefly worked there years ago. That's misleading. Or an ad that guarantees, "We'll get you the biggest refund legally possible, guaranteed." Guarantees like that are almost always problematic and misleading because outcomes aren't certain. They also have rules about fee schedules. If they publish fees, they have to honor them for at least 30 days. And record keeping is key here too. They have to keep copies of mailings, recordings of broadcasts, lists of people targeted by solicitations for at least 36 months. It allows for oversight.
Accountability through record keeping. Makes sense. A very direct question, section 10.31. Can my tax preparer cash my refund check?
Absolutely not. A practitioner cannot endorse or otherwise negotiate any refund check issued to a client by the government. Full stop. It's about preventing fraud and misuse of client funds.
Crystal clear. Now here's an interesting legal point, section 10.32. Does Circular 230 allow non-attorneys like CPAs or EAs to practice law, since they're representing clients before the IRS?
That's a really important distinction, and the answer is a firm no. Circular 230 itself explicitly states that nothing in it should be construed as authorizing persons who are not members of the bar to practice law. Practicing before the IRS is considered a specialized area of administrative practice governed by these specific federal regulations. It doesn't grant a general license to practice law.
Got it. So the scope is limited to IRS matters.
Okay, beyond just avoiding trouble, Section 10.33 talks about best practices for tax advisors. What does good ethical service look like according to Circular 230? Yeah, this section is aspirational but important. It lays out what high-quality practice should involve, things like clearly communicating the terms of the engagement and the client's purpose for seeking advice, establishing the relevant facts, evaluating assumptions, relating the law to the facts, and reaching a conclusion supported by the law and facts. Importantly, advising the client about the significance of the conclusions reached, for example, whether they can rely on the advice to avoid penalties, and generally acting fairly and with integrity in all their practice before the IRS. Plus, ensuring their whole firm follows these procedures. It's really a guide to excellence.
And finally, section 10.35, competence. Seems obvious, but it's explicitly required.
It is obvious, but essential to state. Practitioners must be competent. That means possessing the appropriate level of knowledge, skill, thoroughness, and preparation necessary for the matter at hand. And competence isn't static. If they don't have it initially, they can achieve it by consulting with experts, studying the relevant law, or undertaking other activities to get up to speed. But they must be competent for the work they take on.
Right. You need the skills for the job. Okay, now let's dig into section 10.34. This deals with the standards specifically for tax returns and other documents practitioners prepare or sign. This feels critical.
Absolutely critical. This is where the practitioner's work directly impacts your filings with the IRS. So for tax returns, a practitioner cannot sign a return or advise a client to take a position on a return if that position lacks a reasonable basis. They also can't advise taking an unreasonable position or one that's just a willful attempt to understate tax liability or shows reckless or intentional disregard of tax rules and regulations.
So no frivolous arguments just to lower the tax bill.
Exactly. The positions have to be grounded in law and fact. The same goes for other documents, affidavits, and papers submitted to the IRS. They can't advise clients to submit something that's frivolous, meant purely for delay, or that intentionally disregards rules,
Mhm.
unless, in that last case, they're also advising the client to submit a document challenging the rule in good faith. But generally, no playing games with the system.
Okay. And what about advising clients on potential penalties? That came up under best practices too.
Yes, and it's a mandatory requirement here in 10.34 as well. Practitioners must inform clients of any penalties that are reasonably likely to apply regarding a position taken on a return if they advised on it or prepared signed the return. And, crucially, they must also inform the client about any opportunity to avoid those penalties through adequate disclosure and the requirements for that disclosure. It's about informed risk-taking for the taxpayer.
Empowering the client. That's key. Now, we touched on this with diligence, but how much can a practitioner rely on the information the client gives them? Do they have to audit the client?
Generally, no audit is required. Practitioners can usually rely in good faith, without verification, on information furnished by the client or third parties. However, and this is the crucial nuance again, they cannot ignore the implications of information they know or should know. If the information provided seems incorrect, inconsistent, or incomplete, they must make reasonable inquiries. They can't just turn a blind eye to obvious red flags.
Reasonable inquiries if things look questionable. Got it. Okay, let's shift to written advice. Section 10.37. If a practitioner sends you an email or a formal letter with tax advice, what standards apply?
The standards for written advice are quite rigorous because people rely heavily on it, maybe even to protect against penalties. The advice must be based on reasonable factual and legal assumptions. It has to reasonably consider all relevant facts and circumstances that the practitioner knows or should know. They need to use reasonable efforts to identify the relevant facts. They can't unreasonably rely on representations or projections from the taxpayer or others if relying on them seems unreasonable. And of course, they have to relate the applicable law, including judicial decisions, to the relevant facts.
And here's that really important point again, right? They can't base the advice on the odds of getting caught.
Exactly. This is fundamental for written advice under 10.37. The practitioner must not take into account the possibility that a tax return will not be audited or that an issue will not be raised on audit. The advice has to stand on its own legal merits, period.
Makes perfect sense. And what counts as a federal tax matter for these written advice rules? Is it broad?
Very broad. It includes anything concerning the application or interpretation of, any revenue provision of the Internal Revenue Code, any law or regulation impacting a person's tax obligations, or any other law or regulation administered by the IRS. Basically, if it involves federal taxes or IRS procedures, it counts.
Okay. Can a practitioner rely on advice they get from another expert when formulating their own written advice?
Yes, they can, but again, with conditions. They can rely on the advice of another person only if that reliance is reasonable and made in good faith. Reliance is not reasonable if the practitioner knows, or reasonably should know, that the opinion they're relying on shouldn't be relied upon for some reason. Or if they know or should know the other advisor isn't competent or lacks the necessary qualifications. Or, importantly, if they know or should know the other advisor has a conflict of interest related to the matter. Due diligence applies even when relying on others.
So they still have to exercise judgment. How does the IRS review whether written advice met these standards?
They use a reasonable practitioner standard. Basically, they look at all the facts and circumstances, like the scope of the engagement, the type of advice sought, and ask whether a reasonable practitioner, knowing those facts, would consider the advice compliant with the rules. And notably, the same standard applies even if the written opinion is being used to promote some kind of tax avoidance scheme. The bar remains the same.
A consistent standard. Now, we've talked a lot about individual practitioners. What about the firms they work for? Section 10.36 addresses firm responsibilities, right?
Absolutely. This is crucial for ensuring compliance on a larger scale. Circular 230 puts responsibility on individuals who have principal authority and responsibility for overseeing a firm's federal tax practice. These leaders, managing partners, heads of tax departments, whatever their title, must take reasonable steps to ensure the firm has adequate procedures in place. Procedures designed to ensure all members, associates, employees, etc., comply with Circular 230, especially the core duties in Subpart B and the rules on returns and advice.
It's about setting up systems for compliance. And what happens if those systems fail or aren't followed?
Well, that's where the firm's leadership can be held responsible. A failure occurs if, for instance, they don't have adequate procedures, and this lack leads to a pattern or practice of noncompliance by people in the firm, and it's due to willfulness, recklessness, or gross incompetence. Or maybe they have procedures, but they don't take reasonable steps to ensure they're actually followed, leading to a similar pattern of noncompliance. And critically, if someone in charge knows, or reasonably should know, about a pattern of noncompliance within the firm and they fail to take prompt corrective action, that's also considered a failure under 10.36. It pushes responsibility up the chain.
So it's not just individual errors, but systemic issues. Okay, brings us to Subpart C sanctions. What happens if a practitioner messes up? What are the teeth in Circular 230?
The consequences can be quite severe. The Secretary of the Treasury, acting through the IRS Office of Professional Responsibility, can, after giving notice and an opportunity for a proceeding, publicly reprimand, suspend, or even permanently disbar a practitioner from practicing before the IRS.
Reprimand, suspend, disbar. That's serious. What kind of conduct triggers these sanctions?
There are several grounds listed in Section 10.5. It includes being shown to be incompetent or disreputable. It also includes failing to comply with any regulation in Circular 230, like the duties we've discussed, or acting with the intent to defraud, or willfully and knowingly misleading or threatening a client or prospective client. The category of incompetence and disreputable conduct itself, defined in Section 10.51, covers a wide range of specific bad acts.
Okay, you mentioned that list is comprehensive. Give us some examples. What actions are specifically called out as incompetent or disreputable?
Sure, it's quite a list, but some key examples include being convicted of any federal tax crime or any crime involving dishonesty or breach of trust, or any felony that clearly shows unfitness to practice. Giving false or misleading information or participating in giving false info to the Department of the Treasury or any officer or employee or to any tribunal authorized to handle tax matters. Soliciting business using false statements or coercion, like we discussed earlier. Willfully failing to file a federal tax return or evading any tax assessment or payment or counseling others to do so. Willfully failing to promptly remit funds received from a client specifically for paying taxes. That's a big breach of trust. Trying to influence IRS officials through threats, false accusations, duress, coercion, or offering gifts or favors. Being disbarred or suspended from practice as an attorney, CPA, public accountant, or actuary by any state or federal authority. Knowingly helping someone practice before the IRS who is ineligible, suspended, or disbarred. Using contemptuous conduct in connection with practice before the IRS, like abusive language, false accusations against officials, or circulating malicious reports. Giving a false opinion on tax matters, knowingly, recklessly, or through gross incompetence. This ties back to the advice standards. Willfully failing to sign a tax return as the paid preparer when required, unless there's reasonable cause. Willfully disclosing tax return information when not authorized by law. Willfully failing to file tax returns electronically when required. Willfully preparing returns without a valid preparer tax identification number, PTIN. Or willfully representing a taxpayer before the IRS without proper authorization. It's quite thorough. Covers a lot of ground for potential misconduct.
It certainly does. A very sobering list. It really highlights the level of trust placed in these professionals.
So, if someone is disbarred or suspended, is that it? Is there any path back? That's subpart D, right?
Yes, Subpart D covers disciplinary proceedings and also petition for reinstatement.
Mm.
It's not necessarily a permanent end. A practitioner who has been disbarred can petition for reinstatement, but generally only after 5 years have passed since the disbarment. If they were suspended for a period shorter than 5 years, they can petition as soon as the suspension period ends.
Okay, so there's a waiting period. What do they have to show to get reinstated? It's a high bar. The petitioner has the burden of proving, with clear and convincing evidence, that they are fit to practice again. The IRS, specifically the Office of Professional Responsibility, and potentially an administrative law judge or the Treasury Secretary on appeal, must be satisfied that the petitioner is unlikely to engage in the type of conduct that led to the disbarment or suspension in the first place. And very importantly, they must be satisfied that granting reinstatement would not be contrary to the public interest. It requires demonstrating genuine rehabilitation and a renewed commitment to ethical practice.
Demonstrating true rehabilitation. Makes sense. So wrapping this all up, what's the big takeaway here? What does Circular 230 mean for you, our listeners, whether you're a taxpayer using a professional or maybe even thinking about becoming one?
Well, if we connect this back to the bigger picture, Circular 230 is just fundamentally vital. It's the rule book that ensures integrity and competence in the tax profession. It protects taxpayers like you by setting clear, enforceable standards for the people you trust with incredibly sensitive financial information. It really underscores that the relationship with your tax advisor isn't just transactional, it's fiduciary. It's built, or should be built, on a foundation of strict ethical conduct, competence, diligence, and ultimately trust.
Absolutely. And it maintains the fairness and integrity of the tax system as a whole. So here's a final thought for you to consider. Next time you hear about a tax dispute or maybe even tax fraud in the news, think beyond just the specific tax law involved. Consider the crucial role these professional conduct rules, the rules in Circular 230, play behind the scenes in ensuring justice and accountability. How might a better public understanding of these standards actually strengthen the entire tax system for everyone? Something to think about.